international investing, specifically US investing. And I think what I will do is I will probably take you through some of the points which we have to share. And of course, many of you will have so many questions. We'll be happy to answer all of those. So do put it on the chat box which is there, and we'll try and answer those queries. Let me begin with probably the topic today. Is this the right time to invest in USA? Just as a brief background about myself, my name is Chintan Haria. I've been with ICICI Prudential since the last 15 years, and I'm heading the product development and strategy right now. And in that aspect, I will probably try and cover my views on the US markets, and then what you should be doing more importantly, and then all the questions which come to your mind through the presentation or afterwards. We'll try and answer all of those. So thank you for logging in. Thank you for taking time out for this ClearTax presentation. And I will move on. So if you see, friends, in front of you, what I have done is, instead of just probably speaking about the US markets and what does US contain, we all know, okay, that US is the largest country in the world in terms of market cap. US is the largest country in terms of GDP. The largest companies in the world are US companies. And to that extent, I think over the last 7-10 years, many people have wanted to get exposure to US markets, but have not known how to do it. And more importantly, is this the right time? So what I'm trying to showcase, friends, in front of you is a graph which shows the last 10 years of performance of US markets versus our markets. And clearly, if you see, our markets have basically underperformed the US markets. And the difference in performance is in front of you. It's quite stark. That's because US markets have done better than probably most markets in the world, including India. If you look at calendar year returns, the yellow line or the yellow bars are the US markets, and the darker bars or the black bars are the Indian markets. If you see calendar year returns, except for 2017, virtually every year the US markets have probably done very, very well. So it's been a consistent 6-year period through which US markets have done well. So as we saw in the previous slide and in this slide, the US markets have actually done well for the last 6-7 years. And the rule of investing tells us that whenever there is any asset class which does very well in the past, we have to be cautious about that asset class. To that extent, I will come to what you should be doing with your US investments and where do they fit in. Now, increasingly, if we see, the Indians are looking at diversifying their portfolio. We typically used to invest in India in real estate, in equity, in gold, and in fixed income instruments. Now, many people are looking at investing across the globe. And when it comes to global investing, the first port of call or the first choice is US investments. And we'll probably delve into that a little more. But the questions which come to your mind would be, I have no knowledge about how to invest abroad. Many of us probably are not able to even follow the Indian markets, leave alone follow the US markets in a great detail. Which country to invest in, whether to invest in US, Japan, Europe, so many options, Asian, so many countries are there, and how to reallocate my portfolio as the economic trends change. Now, those are the questions which typically come to your mind. And what I have tried to do over here in this graph is try to explain why the US markets have done so well. If you see, friends, since 2008 global financial crisis, and if you see the chart, 2008 was a year in which the financial crisis happened. And then the US markets saw a very, very sharp fall. In line with the US markets in 2008, the rest of the world also saw a sharp fall, including India, where the Nifty fell almost 66%. At that time, the response which the US government gave is showcased in this chart in front of you. What is the green graph? The green line is essentially the US Federal Reserve, which is equivalent of India's Reserve Bank of India, which is the central bank. It actually went on a printing money spree. What is printing money spree? To get out of the trouble of downward economic trend, the US Fed, which is the US central bank, printed a lot of money. It built out a lot of liquidity. All of y'all would be continuously hearing liquidity has increased in the world, the central banks have increased liquidity. This chart is the most important chart, which is showcasing the kind of liquidity expansion that happened in 2008. And that basically resuscitated the global economy. And for 10 years, US markets did well. And if you look at the 2020, which is on the rightmost part of this chart, again, as a response to COVID-19 outbreak in Jan-Feb, you are seeing basically the US Federal Reserve expanding the balance sheet from $4 trillion to $7 trillion. It is at an all-time high. So friends, if you see the number or the amount of money which is being printed, it is close to $2.5 trillion. That's a lot of money. It is equivalent to almost the India's GDP as we speak. And that money has been brought into the markets, has basically led to the rally in the US markets. If many of you are tracking the US markets and the Indian markets, you would find that, which I had showcased earlier, I'll probably just go to the slide again. If you see what has happened in that US markets, they have bounced back from this March. So the day this green line started to go up, which is the US started printing money, you saw in Indian equity markets and US equity markets also started to go up. And that was purely because of liquidity. What we must remember is that liquidity is something which does not remain forever. And hence, this liquidity driven rally will need to be met with actual economic activity improving in US. And in the next 6 months to 1 year, there's US election, which is on November 3rd, I think. And of course, the economic activity has slowed down because of COVID-19. So these are some of the risks which are there around US investing, which you must be aware of. Again, if I look at why people have actually been investing in US and what is the biggest benefit that you get when you invest abroad or in international markets, just look at the slide in front of you and the circular bulbs, so to say, which are depicting the kind of depreciation of the rupee versus the US dollar. We must remember every time rupee goes from say 71 to 75, the way it has done this year, when rupee moves from 71 to 75 to the US dollar, if you have assets in US or if you have assets in US dollar, you stand to gain from the rupee benefit that comes. In other words, if you're invested, say in US in 2010 at 44 rupees to the dollar, today in 2020, since dollar rupee is 75, suppose you have invested 45 lakh rupees in US in equities or in bonds or in any of the asset classes, that 45 lakh rupees, just by the amount of rupee depreciation that we've seen in the last 10 years, would have become 75 lakh rupees. So one thing which is very important from an international investing perspective, that whenever rupee depreciates, whenever rupee moves from 70 to 75, or in this case, in the last 10 years, it has moved from 45 to 75, you will find that your money, which is abroad, actually adds up in terms of the returns because of rupee depreciation. And we've tried to bring that up in this chart, wherein if you look at the Sensex returns, for the last maybe 10 years, there have been many instances where the Sensex has been flat or negative. And in the years in which the rupee has depreciated, the rupee depreciation benefit has added a lot to investors' returns when they've invested abroad. And hence, from a diversification perspective, many investors are looking to invest abroad. Like I was saying, the trend of rupee depreciation in the last 10 years alone, rupee has depreciated by 63%. That's the number which is in front of you. So rupee to the dollar was 45. Rupee to the dollar today is 75 odd or 76. Now, obviously, do I expect the next 10 years to also be the same? Probably not. And the reason why I say this is that since dollar has been printed so much, or the number of dollars in the world have gone up so much, because as you saw, the Federal Reserve has printed a lot of dollars, we may not necessarily see a 60% depreciation in the next 10 years. A mild depreciation is something which may happen over the next few years, but don't expect a massive depreciation to that extent. I would probably like to caution all investors that rupee depreciation happens in spurts. Rupee stays stable. If you actually look at this graph in front of you, rupee stays stable for a few years, then suddenly it depreciates the way it did in 2013. Again, it stays stable, and in 2018, it depreciated mildly. And of course, in 2020, it has depreciated. My view for the next 5-6 years is that rupee will probably remain slightly stronger compared to the dollar. And hence, if you accumulate over the period of next 5 years, so there are two things right now which you must remember before I speak about this slide, that over the next 5-10 years, if you basically accumulate international assets, and it's very easy to do that, I'll explain how we are going to do it in the time to come. If you actually accumulate international assets slowly but surely, you save, of course, you earn every month, you save every month, and you invest over a period of probably every month in the international markets as well as the Indian markets in various asset classes, fixed income, real estate, equities in India, and also US equities through the various mutual fund routes. You will find that you will have accumulated a good quantum of international assets over the next 5-10 years. And then when the cycle plays out, you will end up getting the benefit of rupee depreciation at the end of 10 years, as well as probably the appreciation in capital that may happen when you are when the entire cycle of economic activity again happens over the next 10 years. So I would say that investing in equities, investing in international assets is very important part of diversification, but you should not do it just blindly. You should probably do it in a staggered manner, in a manner which probably is over a period of next 5 years, 10 years, because the last 5-7 years have been very good for international markets. And so if you look at India looks much cheaper than the international markets like US. So while US markets, if you actually see what has happened in the last many years, because of the formatting change, probably you're not able to see the years, but in the last maybe 15 years or so, if you see, anyone who had invested probably in US dollars, and that because of the rupee depreciation plus the appreciation of the currency, you find that there is a scope to actually, and all of us probably aspire that many of the US universities are very good for education. We would like to send our children. That aspiration is one of the largest aspirations, and in my discussions with many investors, I have seen that the core reason why they want to invest abroad is essentially as a hedge, because at probably 5 years down the line, 10 years down the line, they are looking to send their children abroad for higher education. And that higher education, my friends, is something where you can hedge by accumulating dollar assets over the next 10 years, accumulating international assets in US dollar terms over the next 10 years, and probably 5 years, 10 years, depending on whenever you need to send your child or children abroad. This is one of the better ways to actually hedge yourself from having to shell out a large sum of money, because you all know that international investing, international education is reasonably expensive. But if you start to save with a targeted amount and a targeted corpus systematically over the next 5-10 years, I think it will reduce our burden in terms of having dollar assets at a time when we actually need to spend in dollars for our child's education. Like I was speaking earlier, if you look at the US markets, because of interest rates being very low in US, this is a valuation metric. Many of you obviously may not be very familiar with all the valuation matrices in financial markets, but this is a very simple valuation metric which is speaking of market cap. What is market capitalization? It is simply put, all the companies which are listed in the US market, if I total the market value of those companies, that total market value of those companies is what we call the market cap. And the US market cap as we speak right now is about $30 trillion. And GDP, of course, we all know GDP is the gross domestic product, sum total of all activities of corporations, government, as well as consumption plus net exports. So if we club all of that, the US market cap to GDP, friends, as you can see in front of you, is 150%, while that in India is 65. Just to decode this, a higher number of market cap to GDP means that the valuations are expensive, and a lower number of market cap to GDP means the valuations are cheaper. If we see the Indian markets relative to the US markets, clearly the Indian markets are looking much cheaper compared to the US markets based on what we see in front of us. And to that extent, I would say, friends, that while you are investing abroad, keep a tab of the fact that India is looking far cheaper right now when it comes to comparative investing. So for staggered investment with a goal orientation in mind of, say, having to fund the studies of a child 5 years, 10 years down the line, US markets can still be invested in because there's enough value in US markets in various stocks and sectors. But I think a staggered approach of investing, given the uncertainties around COVID, the US elections, etc., means that you'll be better off not allocating in one go right now and staggering. And the good part is, since you have mutual funds which give you US exposure, you can do it in bits and pieces, and you can do it month by month, and you can do it through a systematic investment plan or a systematic transfer plan, wherein you can basically accumulate investments over long periods of time in multiples of 5,000 rupees or 10,000 rupees, etc. As the case may be, each scheme will have a different minimum threshold. The one thing which I wanted to highlight is the fact that US has printed a lot of money, and US interest rates, if you look at it, have come to virtually zero. So if US continues to bring out liquidity and the interest rates remain zero, as an investor, if I gave you two choices, right? I gave you money and I said I'll pay you 0% on your fixed income instruments or your fixed income, and you'll get some dividend yield or you'll get some growth in your stocks. You would naturally be inclined towards investing in those assets where there is scope for a capital appreciation. You would not invest in a 0% yielding bond. That's exactly why you find many of the US citizens themselves, because their alternative interest rates are too low, they're moving towards equities in a very big way. And today, if you look at as a percentage of the overall savings of US citizens, almost 35-40% is there in equities, versus in India, I think 4 to 5% is there. So the clear low interest rates are pushing the US citizens towards allocating higher resources towards equities. And that's why equity markets have actually done very well in US. And if this scenario of easy liquidity and low interest rates continues, I don't know whether it will continue or not, because if there's a government change, the interest rates can go up and liquidity can come down, and the US markets can go through a turmoil. And that is very well. That is why I'm saying you basically spread your investments. But if this low interest rates continues, then you will see this euphoria turning into a big bubble. So currently, the view stands that on the past comparisons, US markets are expensive, interest rates are zero, liquidity is high. And hence, it is best for investors to actually stagger their investments rather than trying to invest in one go. If you look at it, the same thing which I've mentioned is captured here. For the last 2.5 years, since January 2018, the US markets have been easily the best performing markets, 14% CAGR at a time, after having seen the kind of fall that we've seen in COVID-19. This is as on May 31st. US markets have given a 14% CAGR. No other market among the larger markets is even in the double digits. In fact, India is marginally negative. So if you see clearly, US markets is something where which have done well already in the past. So if you're investing in an asset which has already done well in the past, it's best to basically go slow in terms of staggering your investments over a period of time. So just to basically sum up the considerations before we move out to the question and answers that may have come around the time, which are very important from your perspective. Whatever questions are there, we'll answer them. If we see, there is clearly an overvaluation in US markets compared to their past. It does not mean they cannot remain overvalued for long, but it is important to highlight that market cap to GDP of 150% means that valuations are expensive. It sometimes happens, right, and even in our day-to-day life, that typically sometimes some vegetable becomes more expensive than it's normal, and then it normalizes. Similarly, in equity markets also, it so happens that sometimes because of euphoria, because of liquidity, the market valuations tend to move very high, euphoric, and then they probably normalize. So when you're accumulating units over a long period of time through systematic investment and systematic transfer plans, I think you'll be doing well in terms of making a portfolio of international investing over the long term. Of course, the second factor is rupee depreciation. In the past history, over the last 70-80 years, we've seen rupee depreciating versus the dollar. And probably over the next maybe 5-7 years, rupee will remain strong versus the dollar, because dollar printing will make dollar weak. But that's one thing which will add to your returns at some point of time, when rupee again starts depreciating against the dollar. So if you look at the first two boxes, one is on valuation, second is on rupee. Both right now are not in favor of US investing, and hence from our perspective, it is best to accumulate over a period of time rather than investing in one go right now. Volatility in US markets are probably going to be higher. I think from a US market perspective, we've already seen in the last 5 years, because of the taxation cuts and the buoyant growth that they have seen, most of the US corporations, because of dollar strength, have reported very good numbers. And so from an earnings or profitability cycle as well, US markets are probably at their end. And of course, with 0% interest rate and a debt to GDP, which is at World War II levels, and if you look at the fiscal deficit also very high, US government has now very limited room of continuously keeping on printing money and liquidity generation. for supporting their markets. So these are the few thoughts which probably came to our mind, and we thought we'll summarize them. Is there an easy answer right now that we must invest in US right now in a big way? The easy answer is that it is better to accumulate over a period of time through investing in US dedicated mutual funds or mutual funds which are investing in international markets. So just to summarize, friends, what all I have discussed. The first part is, of course, the taxation, which probably I have not covered. When you're investing in any fund which is investing in international securities, the mutual fund which is investing in international securities will be taxed as per debt mutual fund taxation. In other words, you have to keep the money for more than 3 years. If you keep the money for more than 3 years, you get taxed at 20% after getting the indexation benefit. If you keep the money for less than 3 years, you get taxed at marginal rate. So it's not like the money is locked in. There's no lock-in as such. There may be exit loads as per the scheme's individual attributes. But you need to keep the money for 3 years and more to get the advantage of indexation and a 20% taxation, along with plus there are some surcharges which are there. So clearly there is a taxation advantage which is there if you keep for more than 3 years, and hence keep a longer term view when you invest in international funds or funds investing in US markets. Second is, of course, as an individual, it is very difficult to go and buy the leaders of the world in terms of what are listed in US markets. The US funds give us access to those leaders, and through a cycle, if you accumulate those leaders, even if they are expensive right now, we may get them cheaper whenever the cycle turns, and that becomes very, very good way to keep accumulating for in those leaders or in those good companies with a great market reach in terms of the globalization that is there. So if you think of the globe's best or biggest companies, typically the products which we use on a day-to-day basis, most of them are listed on US stock exchanges, and we can take advantage of them. Not necessarily all those companies have Indian subsidiaries which are listed, and we can take advantage of their growth. So there are multinational companies which are listed in India. Their India businesses are listed generally, and we can participate in them through the Indian markets. But they are global businesses which are many times much cheaper because of the fact that the global businesses may not be as fast growing as Indian companies, and Indian companies or MNC companies in India have a very low float. So typically those global companies which are there in India and abroad, and household names, they can also be bought via the international funds. And if you look at the opportunity, of course, at some point of time, rupee tends to have a strong bias. Then it has to have it has a depreciating bias. I think that also gets covered when you invest in international funds, because you get the benefit of rupee depreciation. So it's one of the ways of diversifying your portfolio. You may have Indian equities. Within Indian equities, like you say, you have large cap, mid cap, small cap, value, growth, etc., and you build a bouquet of portfolio among equities. Then you'll have, as per your asset allocation, you'll have debt, you'll have some gold, you'll have some real estate. Similarly, increasing number of people are definitely looking at widening this horizon and investing in international markets. So that's where international investing can come in handy. Like I said, from a perspective of investor, clearly it's something which you should educate yourself, and this entire conversation is to probably just bring to light the fact that there are many Indian mutual funds which are investing in international markets, and you as an individual investor or retail investor can get the benefit of investing in international markets by eventually accumulating units in these mutual funds which are investing abroad. There are many options in the market, so you can actually search and you can actually see those options which are there, and you can take a call whether you want to invest in US markets, whether you want to invest in fund of funds which are giving you exposure to the entire taking advantage of the entire global funds which are there in the Indian market. You can invest in ETFs and index funds, etc., which are investing in international markets. So at different points of time, you have different choices of India and US or globe. And I think currently, as we speak, just to reiterate, the thing which will fit an investor would be probably to stagger the investments. With that background, I'll pick up a few questions. Thank you for your patient listening. These questions have come to us from the viewers themselves, and I'll pick them up one by one as we speak. Let me just go to the questions. Okay, some of the questions are already being answered as I see it by my colleague, and I will pick up the ones which probably are repeating. So give me a minute. Thank you. Post as many questions as come to your mind, and my colleague Shraddha will be happy to answer them as we speak. The common questions, I have just got a list. Why should one invest globally? I've already answered that. Again, I'll repeat. You should invest globally because it is also a place wherein India is a tiny speck in the world economics. If I look at from that perspective, we are a 3 trillion economy. The world economy is almost $95 trillion or $90 trillion. So we are just 3% of the globe. The balance 97% access is available through the international investing, and that's where international investing, I think, can add a lot of value. If I'll go to the next question. And of course, after I finish this, I'll try and answer some of the queries which have come on the chat and are being answered by Shraddha. What are the applicable tax for investing in US? So, okay. I explained earlier. I'll again quickly explain. If you're investing via a mutual fund in a US scheme, you get taxed as per debt taxation. If you invest directly in US, there are some LRS requirements, which is not the scope of this discussion, but nevertheless, I'll try and address it. There is a limit, I think, of $250,000 of how much you can repatriate per year as an individual, and you can buy and shares property outside in US. But if you invest through a mutual fund, you get the benefit of tax advantage of more than 3 years. You get, if you keep the money for more than 3 years in any of the mutual funds investing in international equities, you will get the advantage of getting taxed at 20% if you completed more than 3 years in that particular investment, and you'll get taxed at 20% post indexation. And that is one of the biggest advantage of investing through the mutual fund route, of course. And then there are no limits as such. The $250,000 of limit which applies to you if you're directly investing in US, that limit does not apply if you're investing in an Indian mutual fund which is investing abroad. Is the mode or remittance simple for international investing? Of course, the scope of this discussion is probably around investing in India options. But if you look at remitting abroad, I think many people are doing it, and it's not that difficult from what I understand. And there are enough professionals and wealth advisors who are probably capable of helping you in that, in terms of how to remit outside. Is there a reporting requirement in case of investing internationally? So if you see, in case of reporting requirements, I think the tax officials or in case of LRS, yes, there may be reporting requirements. In case of mutual fund investing, there is no separate reporting requirement. I think just your because you anyways have the PAN numbers, etc., already linked to the mutual fund. There are no separate reporting requirements when you invest in a mutual fund. It's the same reporting requirements, if at all they apply to investing in mutual funds. Those are the same which apply to investing in international investing mutual funds as well. The next question is, valuation wise, US is expensive compared to other market. Is it a good time to invest now? Again, I've covered that question, but thank you for asking that question. I reiterate and repeat. Is this a good time? After 7 years of outperformance, it may not be the best time. And hence, 5 to 10% of your portfolio, just target 5 to 10% of your portfolio over a period of maybe 5 years. If you have to have an international investing, how do you accumulate over a period of time? Do not put all your eggs at one go. In other words, do not put the entire sum in one go. It is not something which I would advise right now. But over a period of time, if you stagger your investments, it will probably help you in terms of your international investing wealth creation, so to say. Okay, the next question is interesting. How can I take exposure to expensive US stocks with limited corpus of 5,000, maybe 25,000? The good news is that, like in any other mutual fund, the minimum investment levels are pretty low, because mutual fund is nothing but accumulation of many people who actually participate in a fund. Similarly, you can participate with as low as 5,000, or in certain cases, some schemes have a threshold of even probably lower. That depends on scheme to scheme. But with 5,000 rupees also, you can invest in a mutual fund, and you'll get exposure to as many to the units equivalent of 5,000 rupees in US funds or US companies. That's one of the beauties of mutual funds, right? You can invest in very small sums, and over a period of time, those units actually become very big, and you end up generating wealth in the long run. That's where it is said generally that systematic investment plan, which is essentially accumulating units over a month-on-month basis, is one of the best friends that you can have as far as your investing is concerned. And if I may say so, it is also something where compounding was considered as the eighth wonder of the world. SIP, in that sense, over a period of time, tends to help you accumulate units and wealth. And I would believe that's one of the best ways to invest in US right now. View on dollar versus rupee. Clearly, for the next few years, you will find rupee remaining stronger versus the dollar, because like I had shown earlier, and I'll probably I can't show that slide right now immediately, but if you remember, I had shown the slide wherein US was depreciating significantly. Sorry, US Federal Reserve was printing money significantly after the COVID, and the sheer size of dollars, or the quantum of dollars that have come. Simple rule of economics, or even day-to-day life. For example, if the supply of vegetables increases, the prices of vegetables go down. If the supply of oil in the world increases, the price of oil goes down. If the supply of the number of, let's say, in a particular area, if instead of one cinema hall, there are about 10 cinema halls, there is a chance that the prices of the tickets will need to be lowered because the supply has gone higher. Similarly, if there are dollars which are printed, and there are so many dollars which are basically coming into the market, there is a high probability that the value of dollar will come down. So to answer your question, I believe next 3-4 years, US dollar will probably be slightly weaker versus all the other currencies, including the Indian rupee. Can I stagger my investments rather than investing in one go? Definitely. Investing in one go should be done by only those who have a deep understanding of the US markets, who have a deep understanding of their own portfolios, who have a deep understanding of their asset allocations. Most of us obviously do not have that, and I would say please try and stagger your investments. It is in your own interest. View on gold versus rupees. View on gold versus dollar. I think that's the question which is there. Yeah. Oh, gold versus US markets, if I may say so. It's a very tough question, because both are in some sense opposites to each other. If equity does well, means the global economy is doing well, means the dollar prices, or rather the gold prices, are probably muted. That was the last decade. If you see the last decade between 2010 and 2020, few things happened. Interest rates globally came down. Because interest rates globally came down, equity markets did very, very well. Because equity markets did very, very well, there was a sense of complacency, and people were not looking at safe investments, and gold is considered as a safe investment, or a safety investment, if I may say so. People did not move towards gold. They were happy investing in bonds, in equities, etc. And for last 10 years, if you see in international markets, the gold price was $1,950 to an ounce in 2010. Today it is 2020, and it is $1,730 or $1,740 to the ounce, and a 10-year period where gold has given no return. So if you ask me, for the next 3-4 years, given that the last 10 years have been equities versus gold, or US equities versus gold, given my expectation that dollar is going to depreciate over the next maybe 3 years, 4 years, because of increase in supply, which I explained a bit earlier, there is a probability that actually gold can do better compared to US equities, just in the maybe the next 3-year period. In the next 6 months, what happens, you and I can't predict, honestly, because as we all know, equity markets can remain irrational longer than we can think. And from that perspective, it is very important to remember that asset allocation is very, very important. And I cannot predict the exact timing, but if the next 3 years, if I had to crystal gaze, looks like US dollar gold can potentially do better at some point of time compared to US equities, because US equities currently are very expensive. And hence my recommendation that please accumulate your units bit by bit over a period of next 5 years, 3 years, etc. Don't rush in one go. I'll probably try and answer some of the questions now, additional questions. Just give me a minute. So there are many questions I have seen which are, okay. Wow, there are too many questions. So I will. Okay. The question is from Miss Purvi Kulkarni. Thank you, ma'am, for your question. Need your views. If invested in US related fund, will I have to also worry about the currency fluctuations? Is it a good hedge against the rupee? Yes, when you're investing in US, you're essentially investing in a dollar asset. And if rupee fluctuates, in other words, if rupee goes from 70 to 75, you will get the benefit of 70 becoming 75. If rupee goes from 75 to 70 on the other hand, in other words, if rupee appreciates, you will obviously lose out compared to your, when I say lose out, your returns will be lower in rupee terms because rupee has appreciated. So yes, fluctuations in rupee will affect your US investments and returns. This one question is very interesting, and thank you, sir, for asking me, Mr. Shripad Hegde. What is the meaning of indexation? I'm sure actually many listeners may not be aware of this, and thank you, sir, for asking me this question. Indexation essentially is in taxation terms, and I'm taken back to my chartered accountancy days. It is essentially every year there is a cost inflation index which comes up. In other words, a cost of inflation makes a particular cost of living, or inflation is a number where your cost of goods and services keeps on increasing every year, and the government quantifies it and brings it out by way of a cost inflation index, which moves every year. So typically this gets used in real estate very often. Similar concept is there in mutual funds as well. If you see in real estate, and many of you would be very, very conversant with the real estate part, that if you bought a house in 1990 at say 15 lakh rupees in Bombay, that same house would be worth probably 3 crore rupees in Bombay today. So 15 lakhs to 3 crores. If I sell that house today at 3 crores, will my capital gain be 3 crores minus 15 lakhs? The answer is no, because that 15 lakhs will get the benefit of indexation, right? That 15 lakhs over a period of years, the ready reckoner rates or the cost inflation index is applied. 15 lakhs growing every year, suppose 6% is the inflation or 7% inflation, that 15 lakhs cost will get added by 7% each year. And probably that may come to 2.5 crores after adding that indexation benefit which is there. So indexation benefit is nothing but adding to your cost price by the percentage of inflation that the government has notified, and that ready reckoner is available for each year. You can simply have that reckoner in front of you. You can say, what is the inflation index right now? Say it's 240. And what was it in 1990? Say it was maybe 110. And so your cost of acquisition would go up by X amount. So that's the indexation benefit. Even in mutual funds, you get that benefit. If you kept your money for more than 3 years, your cost, suppose you bought something at 10,000 rupees, or you've invested, let's say, hypothetically, you've invested 10 lakh rupees. And that 10 lakh rupees has grown to 13 lakh rupees in 3 years' time, right? So 10 lakhs growing to 13 lakhs, and you kept the money for 3 years. Is your capital gains the difference between 13 lakh and 10 lakh? The answer is no, because there is an indexation component. What is that indexation component? This 10 lakh rupees, you have to add the indexation. In other words, every year there is an index number which comes. So 10 lakhs going to 10 lakh 50,000, 10 lakh 50,000 going to 11 lakh 10,000, 11 lakh 10,000. Say the index inflation that year was 10%. So 11 lakh 10,000 going to 12 lakh 10,000. So your cost will move from 10 lakh to 12 lakh 10. Your 13 lakh is your money which is you are going to get when you redeem after 3 years. 13 lakh minus 12 lakh 10,000, that is 90,000. On that 90,000, at 20% when you pay tax, there are certain surcharges on it, but for simplicity's sake, 20% when you pay tax, it is 90,000 into 20%, which is 18,000. So friends, if you see in any other instrument which does not have the benefit of indexation, your 10 lakh becoming 13 lakh, you would pay that on 3 lakh, you'll pay at your marginal rate of tax. Let's say if you're in the 30% tax bracket, you would have ended up paying 3 lakh into 30%, which is 90,000 rupees. Because of this indexation benefit, you will pay probably a sum which is much lower, say 15,000 to 25,000 or 30,000, depending on the indexation levels, etc. So this is just one of the strongest reasons why mutual funds, from a perspective of allocation, make perfect sense, because you get the benefit of indexation. So any asset where you have the benefit of indexation helps you to reduce your tax outgo on account of capital gains at the time of redemptions. I see a lot of questions, of course, from Ms. Sweta Bhartiya. What's the downside and risks of investing in US, especially given current expected change in government? Thank you, ma'am. That's a good question. So, not that I am a political science student, but from what I have read, if the Republican Party loses and the Democrats get the hold of the Congress as well as the Senate, we may see potentially the interest rates going up and the liquidity coming down. In other words, the easy money policy or the lose money policy being shifted or changed. And there, I believe it has a direct impact, negative impact on US equities. So around the time of 3rd November, while US equities can be supported, if after that there is a shift in government from Republican to Democrat, and if we see liquidity coming down, then probably we are in some sense of volatile markets in US equities. The next question is from Mr. Rahul Kukreja. Hi, sir. Given that you are talking about valuations, US equities are expensive compared to Indian stocks. So given current market, is it worth to invest in US equities? Thank you, Rahul, for asking that question. Clearly, if you ask my personal preference, apart from maybe 5-10% allocation, which is the max that I can think of, I prefer Indian equities for sure. It's just that sometimes people do want to diversify because they have a view that maybe the global markets can do well. So it's a difficult question whether US markets are they are overvalued, yes, but then because of liquidity, can't they be overvalued for long? And if they remain overvalued for long, how long can this last? I don't have those answers, and hence probably Rahul, we can probably take some exposures. It's not necessary to take exposures only in the expensive tech names. Make no mistake. When we speak of US, we only speak or think generally of, I think the term which is used is FANG. No, US is not only FANG. Yes, FANG is large. FANG stocks are large, but US is not only about FANG. US markets are a lot of companies which are strong companies and have very, very strong moats. And I think there is a merit in investing in them, but slowly but surely, not necessarily in one go, because like you rightly mentioned, valuations are not the cheapest that they have been. The next question. I'm just picking the questions because there are many, but okay. The next question, again, I'll pick up one from Vipin Gupta. US has highest number of corona cases. Isn't it much more riskier to invest in US now? Yes, of course. US is the epicenter, and I think India is soon becoming, I think it's already 4th largest India, and it's soon becoming the 3rd largest, and then so on and so forth. So, but India is obviously much more population, 4 times the size of US, I think. Having said that, US markets, or the situation in COVID in US is obviously serious. We see the numbers of more than 1.5 million, and the way I see it is, I can't predict what will happen with COVID, because the last pandemic which happened. So I read a lot about economics, but I did not read about pandemics, unfortunately, in my last 3-4 years stint. And that's why, had I read about pandemics, I would have been probably more clued on as to what's happening around the time in December, Jan, when we started hearing about corona for the first time. But nevertheless, in 1918, when the Spanish flu happened, that Spanish flu took about 1.5 years to settle down. It started somewhere in February 2018. It had a first wave, then it had a second wave, and I think the second wave was more brutal than the first wave. So Are we seeing the history repeat where the second wave, which will be far bigger, when the unlock happened, the second wave was far more hurtful compared to the first wave for all those who did not take precautions. So I think Chicago was the only city in US which took precautions back then in 1918, and it probably survived the Spanish flu much better. I think you are right. There is worry of COVID and in US, and markets have actually kind of delinked from there because of the liquidity that is there. One of the questions I think which Ms. Shweta had asked was, what are the kind of returns that one can expect from US markets? Very tough to answer, and in any given point of time, what are going to be the returns of any market. But I would say at the margin, given the valuation differentials between India and US, I think if the money is kept for longer, maybe 3 years, 5 years, there is a very high chance of Indian markets doing better than US markets. Now, how much can Indian markets give? How much can US markets give? It's something which is very difficult to predict, and hence the concept of asset allocation. A little bit of asset allocation in US is fine, but I wouldn't invest too big in US right now. I don't know. I can't predict what are going to be the returns. One question which comes is there any MF which invests only in NASDAQ? Like, is there a NASDAQ index fund? Thank you for asking that question. We currently don't have that at ICICI Prudential, but yes, you will find in the industry there is a NASDAQ ETF, not an there is a NASDAQ fund which you can actually have access to in the market. Then there's this question, what's the performance breakdown? How much of this performance can be attributed to INR depreciation? That's one question from Mr. Gurmeet Singh. I think if I look at the last 10 years, US markets have probably, or Dow has probably given a return of almost three times. That's a rough number which I can think of, and out of which, say, 60-70% is INR depreciation. So you can say that 60-70% is INR depreciation in the last 10 years, while the balance 200 out the 200-220% is the markets itself going up. So US markets definitely have gone up far higher compared to their 2008-10 levels, and so it's not just the rupee depreciation. Actually, the US markets doing well, which has caused the rally. What percentage should I be invested in US markets? Friends, like I said, and I repeat, if at all you are looking at diversifying your portfolios and investing in US markets or the global markets, I'd say don't only look at US markets. Look at Japan, look at Europe, look at Asia. In fact, today as I speak, probably Japan, Europe, Asia, some of the Asian markets, including the Indian markets, are looking far cheaper compared to the US market. But if I have to just talk about asset allocation, generally 5 to 10% of your allocation in international investing can be thought of. It is something where you'll have to probably think hard, think long, whether you need international investing, whether you have liabilities in international investing which may come up. Like I said, one liability was obviously education of your child, or many people may want to go abroad every year for holidays, and right now, of course, it is not possible. But is it something where okay, I'm not sure whether I'm audible, but just give me a minute. Just give me a minute, friends. Okay. I thought I wasn't audible, but I think I am. My apologies. So the next question comes in is from okay. One Mr. Dilip PG says that why only 5 to 10% of the portfolio over 5 years? Have heard a similar recommendation before, Any rationale in going so low in final allocation? Okay, thank you for asking that question, sir, and I'll probably explain this rationale. See, typically, if you see in general in India, people do not practice asset allocation at all. And when I would say 5 to 10%, even if anyone reaches 10%, it will be great. Given, sir, the fact that, and when I'm saying 5 to 10%, I'm talking about 5 to 10% of your overall allocation, not just your equity allocation. So let's put it this way. You have 100 rupees to invest. Out of that 100 rupees that you need to invest, typically in India, people choose to invest anywhere between 10% to 30% in equities. That is also those people who are actually investing in equities, right? 10 to 30%. Very few people go beyond 50% in equities. I mean, I'm sure the listeners who are there. Yeah. So I tried to actually switch on my camera earlier as well. Now I think hopefully people can see me. If you look at the last maybe 5 years that I have been in this role, I have interacted a lot with investors. Very few people I find who have more than 30% in equities. Most of the people have 5%, 6%, 10% in equities. So when I'm talking about 5 to 10% of your overall corpus in international investing, I'm actually talking of a large number. It looks like people have interpreted it as it being 5 to 10% of the equity portion. No, I'm saying 5 to 10% of your overall portion gathered over 5 years. That's the amount of money that you can see in international investing. And it's not necessary that you invest only in US equities. You could have invested in, so in India, there's no access as such. There's no fund which invests in global bonds. But if you have a large enough corpus, I think there will be ways and means in which you can invest in US bonds as well, or global bonds at some point of time when they become cheap. Today, obviously, global bonds are too expensive. I wouldn't want to invest in a 0% yielding bond, right? So that was my view, that 5 to 10% of your overall portfolio, not necessarily only the equity portfolio. I hope I've answered that question well. Okay. Again, Ms. Sweta Bharti asked this question. You're speaking of European markets, though they are cheaper. Do you see them recovering given multiple challenges in the next few years? Clearly, it is very difficult to predict. If you asked me 5 years back, could I have predicted Brexit will happen? The answer is no. Could I have predicted that Germany would become as strong as they are? I don't know what will happen in the future in terms of euro itself. So there are many questions I'm not denying in terms of Europe. But the way I see it is there are two large currencies in the world, dollar and euro. Dollar's loss normally is euro's gain. In other words, when dollar depreciates, euro kind of appreciates. And that euro appreciation means that there is a high chance of dollars coming into euro as a carry trade, the eurozone benefiting out of it, and the growth coming back. So Japan clear is probably far better in that sense, given the valuations. But then I'm not expert in any of these international markets, so to say, for me to pick which one is better than the other. So a combination approach will probably work. But clearly, if you're investing internationally, do keep the staggering in mind. And Europe may be very difficult for us to also invest because there are very few pure European funds which are available in India. US, there are many. There is one question on, I think, which is a good scheme for investment in present in gold or equity? What is good for investment at present, gold or equity? It's again a question of allocation. I would say, as a typical asset allocation, if I had 100 rupees, and if I look at my own allocation, it is 10% gold, maybe 20%, around 20% in equity, the balance in high yielding Indian credit. So many of you probably don't invest in credit assets or in credit funds, but I would say that there's a benefit of interest rate there, which I'm probably happy to take the advantage of interest rate. So I think gold versus equity, always a difficult call. One is a asset which does not yield much or yield anything, which is gold, while at the same time it is the reserve currency for the last 5,000 years. And whenever there is a financial turmoil, gold does well. So I think I need to keep, given that the world economy is not 100%, we know how it's going to go over the next 1 year. I think having some gold is something which may be sensible. And I think the sovereign gold bonds as a means of investing is something which also probably makes sense from an investment perspective, given that it helps the country in terms of not having to import gold because it is issued by the RBI. So I think that is one way in which you can increase your allocation to gold, which is essentially sovereign gold bonds. And of course, those who want to trade or like to trade or want to invest not in bonds, then not in sovereign gold bonds, there is a gold ETF option which is available. Most mutual funds or many mutual funds have the gold ETF option or the gold fund of funds, gold saving fund of funds also, where you can participate with smaller amounts. So you can have low investments, or the unit sizes are very small in the gold ETFs and the gold savings funds. You can take advantage of that as well, even if you have less money. I'm just trying to see if there are any further questions. Just give me a second. Okay, there's one question which Mr. Gurmeet Singh has asked. Probably I've answered it already, but I will still repeat. What will be the effective taxation on investment gains? In very simple terms, effective taxation on investment gains will be if you hold for more than 3 years, you will have the indexation benefit, so your cost of acquisition will go up. And then the difference between your realized value and the index cost of acquisition, you'll have to pay 20% on that, along with certain surcharges. There's one interesting question on the economy. Is our economy comparatively stable to that of the US? This is from Mr. Ashutosh Singh. Thank you, sir, for asking that question. If you look at our economy versus the US economy, I'd like to highlight certain things which will probably make it clearer. Our interest rates are still at 4.5%, 4% as far as RBI rates are concerned. Our 10-year G-Sec at 6%. So we still have an economy which has interest rates which are high relative to US, which is a mark of stability in my view. We have growth rates in GDP which will be probably upwards of 5-6% starting FY22, FY21. Everything is going to go down, while US may actually be in a much worse of shape. From an economic standpoint, if I look at our debt to GDP, it has not increased significantly in the last 6 years of this current government rule, while in US, the debt to GDP has gone up from, I think, 60% or 70% of GDP to as high as 120% of GDP, back to 1944 World War II levels. It's the highest that it has seen in the last 80 years. So clearly, India's economy with a strong currency, stable government for the next 4 years. US is staring at probably a government change. I don't know what will happen, but they're staring at that. Clearly, India, both from a political perspective, financial stability perspective, we have $500 billion of reserves. And if so much money is printed in dollars, we'll see a lot of money also coming into India. We have a domestic consumption market which is large. Unlike many of the Asian peers, we are still a young economy and becoming younger. Our average age is going to go down till 2030. After that, our average age goes up. Most of the Asian economies, the average age has started going up, which means a low-cost, cheap labor available for becoming factory of the world. So the benefits which China got for the last 30 years, we may get the benefit as a country. And if we can get our manufacturing right, if we can make our land labor capital cheaper, it's already becoming cheaper, but if we can make it cheaper, and if God willing, we are able to become a manufacturing house to the world and get some of the manufacturing to India from China, and we stop being just a trader rather than we becoming a manufacturer. I think India has a far better scope in terms of economic growth compared to US over the next 3 to 5 years. Okay, the question which Mr. Dilip PG has asked is, there is no indexation benefit on long-term direct stock investments? No. So I'm assuming you're talking about Indian stocks. No, in Indian stocks, if you're investing, it is 10% and 15%. So if you invest for more than 1 year, you pay 10% without indexation, and if you're less than 1 year, you pay 15%. That's on the equity side in India. If you're, however, investing in US or any international equity, to the best of my knowledge, if you invest in direct equity, to the best of my knowledge, you do not get an indexation benefit in that. And there, the taxation rates probably are marginal rates of tax. I'm not too sure, so I'll try and verify it. And through the ClearTax medium, I will try and, in fact, they may have a better, I mean, they may already have a clearer answer on that. I'm not too sure if one invests directly in US markets. I know that there are withholding taxes on the dividend, etc., but I'm not too sure on the taxation. I think it is marginal tax depending on the investors' taxation if the benefit comes to India from the US investing. And in the interest of time, since we are hitting 6 o'clock, I don't want to hold all of you all, and all have been patient at listening. I'll probably take one last question before I move out. Just a second. I'm just seeing if there is any interesting question which I have missed. Ms. Purvi Kulkarni has asked, when can the second wave of COVID impact US stocks? I think the second wave of COVID plus the US election, somewhere around October, we'll probably find markets a bit, probably uncertain, if I may use that word. Okay. I think I have covered all the questions which are there on the... Okay. What happens to the dividends received? The dividends received there is a withholding tax. So I think there is a 40%, if I'm not mistaken. So the dividends, okay, there are two aspects to it. I don't know, Mr. Gurmeet Singh, if you are asking me, or Gurmeet Singh, if you are asking me whether the dividends that you receive from your India fund in US, which is dividend. So there are two aspects. One, if you're receiving dividends from your investment in US equity, which you have invested directly, there is a withholding tax which happens in US, which the company itself keeps, the US company. But if you are investing in an Indian mutual fund, which is investing in US equities, and if you are getting the dividend from the Indian mutual fund, that dividend will be taxed in your hand as per the marginal rate. So in India, after 1st of February, when the 1st of February, the budget happened, the rule was changed. Any dividend now that you get after 1st of April, I think 2020 or 1st of April 2020, any dividend received will be taxed in your hand. I think I've covered all the questions. Thank you for your patient listening, and very, very thankful to ClearTax for giving me this platform, for giving ICICI Prudential Mutual Fund this platform to engage with all of you. Thank you, and I'll probably end the session here. It was a very, very interactive session. Thank you for your questions. Thank you all. Stay safe, and I hope this pandemic ends as soon as it is, as soon as it can. Thank you. Stay safe, stay healthy. Thank you. Stay safe, stay healthy.